One of the most popular stocks for investors seeking income has been Altria, ticker symbol MO. There's a couple reasons why this stock has been such a popular choice among retirees and lovers of high dividend payments. It's currently offering a yield exceeding 9%, and it's also a dividend king, having been able to raise their dividend every year for 54 years and counting. Another positive for this stock is that it's a consumer defensive stock, which is a company that experiences stable revenue regardless of the performance of the stock market and the overall economy. Companies like Johnson & Johnson, Coca Cola, and Altria see a constant demand for their goods and are less impacted by changes in the business cycle. They just don't really have these very rapid changes in product sales. Even during economic turndowns, the sale of their products is much less impacted. Despite all of these benefits, the market's been less optimistic about Altria's future for a number of years. Looking at their stock share price going back to 1984, Altria was a dependable long-term grower that consistently did well. But you can see MO reached its all-time high back in 2017 at a price of over $76 per share, and it's been falling ever since then. Despite the gradual fall in share price, Altria continues to regularly increase its dividend and even post some good financial metrics. So in this video, we're going to take an in-depth look at one of the most popular income stocks and try and determine what the future might hold for them and if things are going to improve from a share price perspective anytime soon. For Altria, their bread and butter product is Marlboro. It's their most popular and best-selling product, and it also continues to dominate the cigarette market. At the end of last year, sales of Marlboro represented 42.5% of all cigarette sales in the United States. The next 11 brands combined made up 41.9% of all US sales. But this year, the brand's market share has been decreasing a little as consumers are switching to cheaper alternative brands. In June, the market share of Marlboro fell to 42.1%, but then recovered slightly in the third quarter of this year to now 42.3% according to their earnings report. In 2021, Marlboro's market share was 43%, so this has been a continuing trend for their number one product. But it's important to know, though, that Altria owns a significant number of other brands besides Marlboro. One of Altria's operating companies is Philip Morris, which is actually the company that owns Marlboro. In 2008, Altria and Philip Morris split up amid concerns over payouts to shareholders and smoking lawsuits. Today, they're technically separate companies that have their own stock, but they're still owned by Altria. Philip Morris owns a lot of other brands, including discount brands. You can see that some of their other brands include Basic, Benson & Hedges, Cambridge, Chesterfield, and Players. Some of these brands are international and aren't sold in the States, but a lot of brands fall under the Philip Morris/Altria umbrella. It's likely that some consumers are switching to other Altria products, but it's almost impossible to know how many. The main concern people have about Altria is decreasing cigarette sales and a lower number of Americans smoking. Smoking rates peaked in 1954, with 45% of Americans saying that they smoked at least once a week. Since then, the number has continued to fall, with a reported 12% of Americans smoking as of July of this year. Internationally, smoking and smokeless tobacco product usage remains much higher, although they've also seen a decline. It was estimated that roughly 22.3% of the world used a tobacco product in 2020, with 36.7% of men and 7.8% of women consuming a tobacco product. These numbers have decreased by 27.2% for men and 37.9% for women since the year 1990. Despite tobacco sales falling significantly over time, some good news for dividend investors in Altria is that their free cash flow has remained very stable over the past 10 years. Free cash flow is the money a company has left over to pay dividends, buy back shares, and pay down debt among other activities. So with smoking rates continuing to fall, it's worth asking how the company's been able to maintain its revenue over the years. Altria's been able to achieve this primarily in two ways. The first is by becoming a lot more strategic in their product offerings. In recent years, they've been branching out into other types of products, including pot and alcohol, but their tobacco products still represent their largest source of revenue. The company's been focusing on three main areas besides traditional cigarettes, including e-cigarettes, heated tobacco, and oral tobacco. As most people probably know, Altria spent billions of dollars on acquiring Juul, which is a really popular brand of electronic cigarettes. The deal was ultimately a disaster after the FDA banned the flavored Juul pods that made them popular, and Altria exited their investment. You can still buy Juul devices and their non-flavored pods, but what made them popular, their flavored tobacco, is still currently banned. Earlier this year, Altria spent approximately $2.75 billion on acquiring a different e-cigarette brand called Enjoy, which at the time was the third best-selling e-cigarette brand in the US. In March, it was reported that they control roughly 3.7% of the vapor market, with their main competitor, Vuse, dominating the market at 41.5%. Enjoy appears to be Altria's newest focus, aside from their already established products. As the company claims they're being more progressive by moving towards a smokeless future, they've been highlighting the positives of their Enjoy devices, which have larger batteries, larger pod volumes, and offer more puffs per pod. There's still a lot of potential for growth with this product, as store prevalence is still far behind that of their leading competitor. Altria has also been branching out into heated tobacco. Heated tobacco, or HTP products, is still a relatively unknown form of consuming tobacco. They're devices that contain tobacco that's heated and not combusted. This is another healthier alternative to traditional cigarettes because many of the harmful and potentially harmful compounds found in cigarette smoke form as a result of combustion. Since these products deliver nicotine without combustion, when cigarette smokers transition to HTP products, they have the potential to significantly reduce their exposure to the toxic constituents found in cigarette smoke. In March, Altria announced Swick, which is their heated tobacco product that's still being developed. It's not yet known how successful this product will be or if smokers will be convinced to switch to this new form. One reason for Altria developing this product in the first place is due to a large number of smokers feeling uncomfortable with being seen puffing on traditional cigarettes. The third area Altria continues to build upon is their oral products. Altria owns US Smokeless Tobacco Company, which as of last year controlled 46.4% of the oral tobacco market. Their number one brand, Copenhagen, represents 27% of all US smokeless tobacco market sales. One of their newest brands, On, has seen steady growth in retail sales from 4 million cans in the first quarter of 2021 to 19 million cans at the end of 2022. So these are the three big areas the company has been focusing on for growth as consumers continue to move away from traditional cigarettes. The second way the company's been able to combat falling cigarette sales is by increasing prices. In 2023, the average price of a pack of cigarettes in the US was roughly $8 per pack. In the 1950s, the average price of a pack, adjusted for inflation, was $2.29. Increasing prices is significantly easier than convincing consumers to switch to a new product, so this is something Altria has been relying on for a long time. But the million-dollar question is, have any of these new and alternative product offerings, as well as raising prices, made any significant difference despite decreased tobacco sales? Let's now take a look at some of their financials. Starting with their revenue over the last decade, we can see that things have slowly been moving upward. They've been posting higher and higher revenue numbers every year while also reducing their operating expenses over time. The issue though is that their other product segments just haven't been doing well enough to compensate for their lower cigarette sales. Looking at their latest 10Q, their cigarettes earned Altria roughly $16.4 billion for the 9 months ended September 30th of 2023. Their oral products only brought in about $2 billion, and their other products including Enjoy and their alcohol only brought in $33 million. This means that cigarettes still make up over 89% of their net revenues. So up to this point, their new ventures haven't come close to replacing traditional cigarettes. It's worth mentioning again that Enjoy is still a brand new product that isn't available in most stores yet, and their HTP product isn't out yet. But these segments are going to be important if Altria really does want to see a strong recovery. From this information, we can gather that their increasing revenue is pretty much all thanks to raising prices and not new product offerings. In addition, Altria continues to face new challenges in their industry. For a long time, officials have been trying to ban menthol cigarettes, which are a very popular variety. It now appears that that's much more likely to happen sometime next year and would certainly eat into Altria's profits. Other organizations and groups continue to push bans on smoking and e-cigarettes, which isn't anything new. But it just goes to show that Altria has to continue to adapt in order to remain relevant. In my opinion, in order for a strong share price recovery in Altria's stock, one of a couple things has to happen. You can't keep raising prices forever, so something is going to have to change in terms of how they conduct their business. One of their new products or investments is going to have to be a strong success. Getting e-cigarette smokers to switch to Enjoy from Juul or Vuse I think would be the best thing. Another possibility would be if their investment in the pod industry would become wildly successful. But for now, until Altria finds another successful product, continuing to raise prices will keep working, but the question that's impossible to answer is, for how long will that work? Nobody knows for certain, but I personally sold all of my shares of Altria shares years ago, and I currently don't have any plans to buy in again until they post more encouraging results. But with that being said, that's going to conclude today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus, it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.